Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Do I invest in NVIDIA, who makes the processing engines? Do I invest in data centres? Because I know they're going to need lots of more data centres to drive all this stuff. Do I invest in the companies that are developing the technology, like OpenAI? Do I look at some startup that's providing the data? Appen will be familiar to most Australian investors. Or do I rely on someone else to do this research and buy a thematic ETF?
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. There comes a moment in every investor's life where they're looking for a little more, where you want to diversify beyond your core long-term holdings. Believe me, it happens to the best of us. But what are the traps and how can you satisfy these urges with a margin of safety? Joining me in a return to the podcast is whispering Vince Scully, Chief Sherpa at Life Sherpa. G'day, Vince.
G'day, Phil. Back again.
So let's recap the concept of the core investment approach. What is core investing? And we're talking about core, satellite, and looking at different ways of investing because many investors, like I've done this as well, we have your core of ETFs and you want to go and have a dabble, have a little bit of a punt. So tell us about the core of investing.
Well, the concept of core and satellite comes from the general principle that for the most part, your good, solid, steady returns are going to come from a core of low-cost, largely indexed funds across a range of asset classes. And so that might be some equities, some global equities, some emerging markets, some big companies, some small companies, some bonds, some gold, some cash. Most of those can be delivered algorithmically for very low cost. And the cost of a large cap ETF today is as good as zero. I mean, it really doesn't matter whether it's 0.04% or 0.07%. And so that should be the main core of your portfolio. The challenge with that is that it can often be perceived as dull or boring, and that watching compound interest work for you is a little like watching paint dry. So people have this natural human interest or desire to be doing something. And that desire has been captured by the funds management industry to deliver a wide range of niche products, whether that's taking a more active or concentrated or high conviction position in equities or themes or more exotic asset classes. And that gives people or scratches the itch of wanting to do something. And the concept of core and satellite is that you have these things floating around your core just as the planets rotate around the sun. And the expression core and satellite was actually coined about 25 years ago, so not as long as you might think, given I guess we've had satellites since the late 50s. But a guy called Harold Evansky, who is the guy who gave you the 3-bucket retirement strategy, is largely credited with this one. And he was working off the research at the time, which was starting to show that algorithmically driven index funds were generally the way to deliver efficient returns within a specific class. And he said, well, maybe there are other things that you should be doing where you might seek to outperform, whatever that might mean. And so he suggested that the core, and bear in mind, 25 years ago, ETFs were very new technology.
He's an American?
He's an American.
Yeah.
Interestingly, he's an ex-civil engineer who became a funds management salesman in his later years and created a financial planning business in his late 40s. He was Dean of Financial Planning at, I think, University of Texas, but certainly a US non-East Coast university. And he sort of came to this odd conclusion that says if you conclude that active management doesn't work, and there's a lot of evidence that suggests on the whole it doesn't in most asset classes, at least not enough to outweigh the extra costs and taxes that it incurs.
And mental anguish.
And or mental pleasure, then you shouldn't be doing it in your core. But maybe you should be giving it a punt in a small proportion. So they having proven that it doesn't work, maybe you should allocate a small portion of your portfolio to attempting to prove that it might be right. And so he coined the expression. And it's since been co-opted by just about every scoundrel and unlicensed influencer in the personal finance space to flog all sorts of crazy stuff. Now, that's not to say that it doesn't have merit, but it has been abused by, I think Robin Powell calls the industrial funds management complex, to create all sorts of products, many of which have greater marketing substance than they do have investing evidence substance.
And that's where they come from, because a lot of these, we call them thematic ETFs now, the product of research on social media when they see what people are actually talking about in investing forums, aren't they?
Yeah, and sometimes that makes a lot of sense, that if there are genuine trends or mega trends, as they get called these days, that could conceivably change the way markets will perform in the future. And climate change is a really good example here, that there is a chance, a probability, I don't know how big that probability is, that the market's just got this wrong and that it has actually mispriced future carbon risk. That's a non-zero probability. I don't know how big it is, but it's not zero. And so should you be preparing for what happens if the market is wrong? The markets are generally efficient and they generally take into account most information as it comes to mind, but there is a very real possibility that we've all got this wrong, and the value that the market has placed on oil deposits or gas deposits might not fully reflect these future risks. So that might be a reason why you would, as an investor, go, well, actually, I've got my core over here, invested in the ASX 200. Maybe I should be going overweight hydrogen or overweight solar or overweight carbon credits. I don't know, but some asset that might be able to take advantage of that market mispricing. Now, that is a punt, that you got to believe that you know something that the market doesn't and invest accordingly. So that obviously means you don't punt 100% of the Muscatello fortune on this, but there's a reasonable argument that putting something in a contrarian bet makes sense. The big challenge is, what horse do you back and how do you get exposure to it?
I just wanted to butt in there because there is a non-zero probability of just about any megatrend emerging, really, and you could spread yourself really thin.
You could. And
because it could be, it could be climate change, or it could be, I don't know, the number of probable outcomes in the future are infinite. We don't know what they're going to be, and it really comes down to the personal choices of the investor and what they personally feel and believe in.
That's right. In that level, that's right. You go, what is your conviction that you believe that the market is wrong somewhere, and it will be wrong somewhere. But working out where it is in advance is not an exact science. And
there's a lot of very smart people, very smart brains working on these.
There are.
All of the time.
And so identifying a mega trend is possibly the easy part of that exercise. So if you go back to the late 90s, when the internet was the next big mega trend, you would have been encouraged, and there were a gazillion tech funds launched in 98, 99, or 97, 98, 99, which were based on the thesis that the internet was going to change the way that we live our lives. And here we are now 25, 30 years later when it has changed our lives. But what would you have bet on in 1996, 97, 98 on how to take advantage of that trend? And people were betting on a whole bunch of e-commerce sites that...
Pets.com is the famous
Yeah,
example.
all of those ones. And very few of those still exist. The more rational investor, to the extent that such a thing exists, was generally betting on the tools, the picks and shovels of the gold rush. So they were betting on things like Cisco. So Cisco was probably the thinking man's punt on the internet.
But that didn't work out well, did it?
Oh, no. I mean, it worked really well until 2000, and I'm not sure it's recovered where it was. And certainly Cisco is not the heart of the internet like it was.
I mean, you could mount the same argument that NVIDIA occupies that same picks and shovels kind of idea in space.
Yeah, and you can go back beyond the 90s. You go back to the 80s, and the Far East was the mega trend. This was the era of the Japanese, the growth of Southeast Asia.
That's right, when they were buying up most of Australia, if people don't remember.
And, you know, if you just look at the number of funds launched in the 80s with some sort of Far East label on them, and we all know how that story ended. You know, Japan was 40-something% of the MSCI Global Index in 89. Today it's more like 7 or 8. And I drank that Kool-Aid big time in the 80s. And dumb decision, but actually it saved my bacon in 1987 because Japan fell less than the rest of the world. So it actually delivered the diversification benefit in my portfolio and saved me going broke in 1987. That doesn't mean it was a good decision. It had a good outcome, and it was a mega trend that is possibly coming true now. You know, China, India are now global superpowers in terms of economics that they hadn't been for 400 years. And so, you know, there will be very few portfolios that don't have Chinese listed businesses in them. You know, Tencent, there's a whole bunch of them. So, you know, not only do you have to get the trend right, you've got to get the timing right, and you've got to get the horse in the race right. And getting all of those right at the same time is almost impossible to pick ahead of time. Now, none of that is a reason to not do any of this. It's just a flag that says, be careful about drinking your own Kool-Aid. Do you really have a scientific basis for this, or is it a punt? And having a punt is an intrinsic part of Australian culture. So I wouldn't be encouraging or discouraging anyone from having a punt, but I think you've got to understand why you're doing it and the role it plays. For me, my desire to scratch that itch and have a punt, I go to the TAB. And I know that as a mathematician that my expected return is less than zero because the TAB's, New South Wales TAB's payout, I think, is 96% or 92%. So I know that on every individual bet, my expected return is negative. I'd like to think that my proportion of the payouts will be higher than my proportion of the wager pool, and therefore I'll come out better than average. But I'm not naive enough to know that that's a dead set. But what it does is it scratches that urge, and I can lose a few $100s on race 6 at Randwick rather than tens of thousands of dollars out of my retirement pool. But for other people, you know, there is a strong narrative that I know something. So I buy an iPhone. I'm an iPhone user, and therefore Apple is something that's very tangible to me. I use iTunes, I have an Apple TV, I use an iPhone, I've got a MacBook. Maybe I should put some of my investment there as well. So that's a powerful narrative, and it's very useful in terms of the advice process that as a stockbroker, I've got a new story to tell every day because the market goes up when the market goes down. It's very rare that the market stays flat for more than one day at a time. So it means that I've got new news. And so investing porn sells well. It generates eyeballs, it creates new content, it's easy to create. And so it's always new news. So it gives me something new to talk about every day. And as humans, we love stories. that numbers mean much less to us as humans than do
And this is where
stories.
this is where megatrends emerge, isn't it?
Exactly.
Yeah.
And so, I mean, you raised the AI point. Quite clearly.
Oh, I wanted to get into the AI because you could say, okay, this is a megatrend. AI is a megatrend. But how do you invest in that?
Yeah. So do I invest in NVIDIA, who makes the processing engines? Do I invest in data centers? Because I know they're going to need lots of more data centers to drive all this stuff. Do I invest in the companies that are developing the technology, like OpenAI, that manufacture ChatGPT? Do I look at some startup that's providing the data? Appen will be familiar to most Australian investors. Or do I rely on someone else to do this research and buy a thematic ETF?
Can I just add there that there are other companies? I mean, are you investing in AI if you invest in John Deere? Because their tractor technology is using a lot of artificial intelligence because they've got a lot of data to deal with. Yeah. And they can use that data to make the process of agriculture much more efficient. That's another way of doing it.
It
as
is.
well.
I must admit, I never thought about that one, but you're right. Just about everything we touch has
Drone companies, they're gathering all this data about mine sites and agriculture as well.
I'm sure my new washing machine has some AI in it to work out how clean my clothes are. But yeah, so I've got to take a punt. And the track record of punt taking, particularly in the technology space, is patchy to poor. So probably the biggest name in this space is ARC. So Cathy Woods at ARC. Between her funds, she's toasted about $4 billion of largely retail investors' money. And instantly, that is more than the total amount paid for financial advice in the US. So is that Cathy's fault? Probably not. Is it the media's fault? Possibly. So she certainly makes for a great talk show guest. So if you are running a business news in the morning, getting Cathy delivering some serious clicks saying Tesla's going to the moon, that's gold if you're a media producer. Is it a particularly good investment story? I don't know. I've never been a Tesla fan. I'm probably going to get lynched for this. But whilst it's great technology, it's a very unsatisfying driving experience. It may be fast, but it's like a Trappist Muscatello on four wheels and doesn't feel like what $120,000 a car should feel like. Does that mean Tesla's not a good investment? I've got no idea. I don't think the market particularly cares what Vince thinks of the latest Tesla model.
There's a lot of love out there for Tesla.
There is. And you might conclude that electric vehicles are a mega trend. I think you would certainly conclude that was a mega trend. It's gone well beyond a fad or a fashion. It's here to stay. So how do I invest in it? Tesla's delivered most of its return or excess return before it joined the S&P 500. So if you weighted in your core, so your core S&P 500 fund would not have had Tesla in it until it joined the S&P 500. And it was a very big company. It was bigger than much of the 500 companies by the time.
Bigger than all the other car companies?
Well, certainly bigger than all the other car companies in terms of market cap. And so your core portfolio would not have had a Tesla investment until it joined the S&P. So if you wanted to capture that excess return, you had to do something. And of course, the funds management industry is more than willing to deliver product to allow you to
scratch
do that
itch for you.
And ETFs have made it easier and simpler because liquidity is much less of a problem. If I have a closed-ended fund, every time someone wants to come in or out, I've got to liquidate the underlying assets, whereas ETFs don't suffer from that problem, that most of the trading is in the secondary market. And to the extent that that secondary market differs from the price of the underlying assets, the market maker will step in and close that gap. So you can have a very small ETF, and as long as it's got a big enough of a management expense ratio, it can be profitable. And so we've seen a massive growth in the opportunities to take these positions. And many of those have got a lot of high-level research in them. So back in 2006, I launched a green energy fund, which simply tracked an index which was then called the Wilder Hill New Energy Index, which today is the Bloomberg New Energy Index. And it was an active index. So the boffins at Wilder Hill were creating a index of 20-something stocks that tracked new energies. So that meant solar, wind, batteries, smart grids. Now, this is almost 20 years ago. And every quarter it looked at the best. So BYD was a member of that index back in 2007.
What was BYD? Remind me.
One of the biggest EV car companies today.
Okay, yeah.
Back then it was largely a battery company. And so
that's all an EV is, basically, isn't it?
Yeah,
it's a battery and a couple of electric motors.
It's a go-kart with a big battery. And so that allowed a fund manager to very quickly and cheaply deliver a clean energy fund, which simply had to track this index, and you license the index from Wilder Hill, or Bloomberg today. And we're seeing that across all these ranges, that Wilder Hill was probably one of the leading researchers on clean energy in those, and that's why Bloomberg would have bought them. And so they made the money by licensing this index and their research. So you were getting the benefits of very deep research to allow you to make that decision as to how do I back the clean energy revolution. How's it worked out? Well, it's been
what's the returns?
It's been a bit patchy. I don't know what the returns are off the top of my head. We did it as a structured product which had some capital protection in it, which worked really well until it didn't work in the GFC, when we had the cost of options went up because volatility went up and the interest rates fell, so the cost of your protection fell. So they ended up cashing out. So everyone got their money back, but nobody made a particularly good return. But that index still exists today. I'm pretty sure you can still buy an ETF that tracks it. And so there are ways you can play the satellite story today that you couldn't realistically 25 years ago when Harold Evansky coined the term. So, as with a lot of things, though, just because you can doesn't mean you should.
Yeah. And I think it's worthwhile reflecting for a moment the financial industrial complex and how many fingers are in the pie. Because you just mentioned an index. You have to license an index. There's companies that spend, the Singapore Stock Exchange, for example, does a lot of indices, which they then license out so that they can be benchmarked or used by a fund management company to create a fund on.
Yeah. So when you pay BlackRock 4 basis points, 0.04% for your IVV S&P 500 ETF, S&P is probably getting 1 or 2 of that.
For the licensing, for the using of that index.
Yeah, which is why BetaShare is using things like selective indexes, which are cheaper.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
But it still begs the question, why is that index the one that is going to provide a return for you?
Well, I think you probably got to look at, what is an index?
I know. We're getting deep into the weeds here, but I love to actually understand this because, okay, you've got a fund, you've got an ETF or a managed fund, and it's based on an index. But you've got to really dig deep and say, well, what is that index? Why is it being created? What does it actually mean?
Yeah. So if you just look at the S&P 500 or a major market index.
Well, that's a pretty basic one. It makes sense, yeah.
That answer is a tool that sets out to answer the question, what happened in the market today? So that's a question that, as long as we as humans have been trading, people want to know the answer to. Even the Merchant of Venice, what's that line from the Merchant of Venice? Is how goes it upon the Rialto? And up to the 20s, I think, 1920s, we looked at things like the ratio of declines to advances. So it'd say, did more things go up than went down? And that tells me it's a good day. That's the 100-year-old equivalent of looking at the screen and squinting and going, does it look mostly red or mostly green?
The heat map, market heat maps. Yeah.
So in the 20s, the Dow Jones Industrial Average was invented, which I think was 23 stocks at the time. And they were equally weighted. So it just said, what are the 23 stocks that represent the major sectors across the index? And then we can track how well that basket of shares performed. And so when the basket as a whole's gone up, then we think the market as a whole's gone up. That's a fairly complicated mathematical calculation. So over time we evolved and it's difficult to replicate in practice. So we evolved what's called a market-weighted index, which is most standard index. And in that case, the basket contains more of the share that's worth more. So when you start on day one and you say, well, here's the top 100 or the top 200 or the top 500, as the market moves up and down, the value of that basket will reflect the overall movement in that. That those price movements will move the relative value of each of those within your portfolio. So you don't actually have to trade every day to get the return that basket is delivering you. From time to time, you do have to go, well, actually, those three are now numbers 600 because they've done badly. Therefore, we need to replace them with new ones. And usually that's done quarterly. And part of the skill in designing an index is how do you bring things in and out of the index? Because you don't really want to be going, well, it's 101 today, therefore it's not in. It's 99 tomorrow, therefore we'll put it in. Oops, it's gone back to 101, we'll take it out again. So managing those ins and out is the trick. And the other twist you get on indexes is, what do I do with the bits that don't trade very often? So you've got a business like News Corp, where the Murdoch family controlled big chunks of it. So whilst that's part of the value of the company, it's not actually available to trade. So the index might include or exclude or downweight that bit. It might look at companies that are domiciled offshore differently. So Shell, I think it still is listed on both the New York Stock Exchange and the London Stock Exchange. So how those two indexes include Shell, BHP in Australia, when it was listed in the UK and in here. So all of those things go to deliver slightly different returns. And so it really answers the question, what does the market do today? And it also gives you a benchmark to track your own performance. Because performance on its own is meaningless unless you can go compared to what. So if I'm investing in large cap Australian companies, so if I've got a portfolio of 20 big companies in Australia, I should be able to answer the question, how did my portfolio compare relative, so my basket of 20, how did that compare to the overall 100 or 200 or 300? And the difference in performance is a measure of a whole bunch of things. It could be a measure of my skill. It could be a measure of luck. It's more likely to be a measure of factors that by choosing the bigger companies, I'm exposing myself to the size factor, and large companies, as a general guide, underperform small companies, which is really a reward for risk. And so if my 20 is mostly consisting of stuff between 200 and 300, I should damn well expect a higher return than if I'd bought the top 20. If I'm not, I'm doing something wrong. Or maybe I've just got the timing wrong. So it answers the how did the market do and how is my portfolio performing? And what the research now says is that it is very difficult to consistently pick a subset of the market and actively trade it and over time deliver a higher return than the market as a whole, all other things being equal. Now, if you want to take a punt around that, that's where your satellite comes in. And how much of a punt are you prepared to take? You know, if we're saying that active management in general doesn't work, it's not going to work any better for 10% of your portfolio than it does for 100% of your portfolio. So understand what you're getting for this 10 or this 20, and that you're not just a patsy for the latest fad or fashion.
So how do you identify that?
With great difficulty, Phil. I don't think there's any particular science to it.
Is it just about, is thematic investing just for you to be able to talk about it with your friends?
Well, yeah. And
in a way, I mean, that seems to be the main purpose of it. I mean, if it's going to be only 5% or 10% of your portfolio, it's not going to make a big difference to the overall return.
That's right. But one of the things it does create, and I think this is important, is it helps with engagement. So to the extent that the ability to talk about this down at Ryan's bar on a Friday night to your mates gets you thinking about investing in your 20s or 30s. That has to be a good thing. Just when the market goes up.
As long as it's not the same as punting as well. You're not doing it in the punting.
Yeah, I mean, there's nothing wrong with a punt. I mean, Australians are probably some of the biggest punters in the world, and it's just ingrained in us culturally. So I'm not against having a punt. I choose the TAB, but many of my colleagues choose penny mining stocks, and it's certainly not my place to form a value judgment that punting on some Mickey Mouse mining stock owned by a few rich punters on St George's Terrace in Perth is any better or worse than Horse 3 and Race 6 at Randwick.
And of course, this is because we've been looking at the satellite approach as being thematic ETFs, but it can be anything.
It can be. And this is potentially a more useful aspect of it. So you might, for example, say, well, my core is the big developed markets. So I'm going to have some Australian large cap equities, some US large cap equities, some global large cap equities, maybe some emerging markets. I'm going to have some Australian government bonds. I'm going to have maybe some slightly higher risk bonds in my core. And I might look at some real estate, some individual shares. So I might look at some what are called alternatives, which used to be code for not bonds or equities. And now it means, people would often...
It could be vintage cars, it could be artwork,
exactly.
It could be wine.
So all of those potentially have a place in our investing life. Just understand why you're doing it. I've got a mate who collects cars and has done remarkably well. So
it's been a great asset class.
And I'm sure the amount of money he spends racing them wipes out any gain he's got on the investment side of it. But that's not really...
What's money for?
Exactly. That's you've got to be looking at what you're doing. And not all of us, all of the time, are alpha maximizers or excess return maximizers. And the advantage of the core satellite approach is that you capture the beta, which is the market return. You don't waste it on your behaviour. You don't waste it on taxes. You don't waste it on excess fees. And you can rest well knowing that you're going to capture the market beta. And then you can safely have a punt with whatever's left to scratch these issues. So my car collecting mate, he lives a great life. But I don't think he would say, well, other than to his wife, I don't think he would say that if you really pushed him on it, that overall he's ahead on his car collection. The collection itself probably is ahead, probably delivered a better return. But the amount of money he spends racing them, or more than point, fixing them up after he races them, would wipe out most of those. I used to have a lot of clients who had taxi plates in their self-managed super funds. And that was a highly profitable investment until Uber came along. And that
just killed it. Yeah.
And that government monopoly destroyed the prices of those almost overnight. So just understand why you're doing it and value the outcome that that's giving you. But don't kid yourself that it's a better risk-adjusted return. It might be, but have fun.
Does Life Sherpa offer any of these kind of thematic opportunities in the portfolios?
We generally don't. So we would say to our members, look, let us look after the core, your fortress. So we are evidence-based investors. So we construct portfolios based on modern portfolio theory, mean variance analysis, and come look at the evidence and construct a portfolio that will give you it's a market return within the sector you choose, but the value is actually which of the sectors we're choosing. So when I recommend that your Australian equity, large cap equities portion of your portfolio should be fulfilled using VAS, the Vanguard Australian Share Fund. VAS doesn't know I've recommended it. It doesn't know that you haven't thrown a dart at the dartboard and picked it. It will do what it does. My job as a portfolio constructor and as your advisor is to make sure those market returns end up in your pocket. And the reasons they won't end up in your pocket is largely your behaviour, and your behaviour is largely influenced by the asset allocation. So by aligning an asset allocation to your psychology and to your goals and objectives, you will end up with more in your pocket. If you look at the Dalbar research, Dalbar is a US research house, and they track fund performance versus investor performance. And consistently, individual investors, in their case they measure the S&P 500, but you could do this in any market, that the average investor in the S&P 500 underperforms the S&P 500 by between 3 and 5%, depending on what period you look at it. And that's because humans naturally put more money in when the market's booming and feel reluctant to invest when the market's not. And therefore, they're buying high, selling low. And that's a recipe to lose money. So where a Life Sherpa member is keen on having a punt on lithium or climate change or whatever, we would encourage them to do that themselves, and we'll provide them with a share site subscription to track both the tax implications and the relative performance of all of that. And for most people, that's a hobby. It's not necessarily a pure investment strategy. And I think understanding the difference is critical.
Well, it's something to talk to your mates about, really, isn't it?
Absolutely.
That's right. So crypto, this could be considered to be a mega trend or an emerging theme or something, I don't know what even to categorise that. What are your thoughts on crypto as an alternative asset class?
I mean, it's certainly an alternative.
People love to talk about crypto.
They do, and it's a bit of a male thing that almost all of the new male members that come to our digital door will have some holding. And this is a real classic 1990s dilemma that you can generally, I think most people would accept that the blockchain has a role to play in recording and moving assets around the world. Now, the blockchain is just a distributed database, and we've had them since the 80s. So what's special about the blockchain? It allows us to do it in a permissionless way, that you don't need a central authority that you have to trust, and people can update it. And that's got application where you have a broad range of people updating stuff and tracking agricultural commodities through the chain from the field through to your stew that you buy at the local cafe is one of those sort of applications. Whether it's got an application in moving cash around the world or tracking the registration of shares is a much harder conclusion to come to, because in many cases having a central authority adds value in that chain. And the cost of going permissionless is very high.
Is that a trust issue?
No, it's more about Bitcoin, for example, achieves this permissionless by having what's called a proof of work. So in order to get the right to update the blockchain, you have to solve this mathematical puzzle. And that consumes a whole bunch of energy which has to be paid for somehow, and people have to be rewarded for doing that work, which creates cost. Just as SWIFT, for example, clips the ticket on every dollar moved around the world. So it's not unique to blockchain, but it does come at an inherently higher cost. The other option is used in Ethereum, I think, which is more a proof of stake, where you actually have got to put some money up. So this is all really about proving that you are who you are and that you have some stake in correctly updating the database. So there are absolutely places for that. Some of the suggested uses, particularly around currency exchange around the world, is largely driven because the existing incumbents are extracting higher prices than they need to. So if you're running Swift or Visa, you actually have a dominant market position that you can protect by dropping the price over time. So where the application is in finance is, I think, still open to question. But let's assume that you accept that the blockchain is the way of the future. And I think most people will accept that it's got some role somewhere in tracking something. Your next question is, well, how do I
invest in it?
How do I invest in it? So what am I going to buy? I could buy graphics cards. I could buy clean energy because, these guys use a lot of... and in fact, some of the best miners, the listed miners, actually make more money out of trading their energy than they do out of the Bitcoin mining itself. I could invest in a exchange that trades these things, or I could invest in the coin itself. And I invest the coin or token itself, I still now have to pick one. And many people, particularly the early adopters, have made a lot of money in this space. There's no doubt about that it has created a significant number of extremely wealthy people. Does that mean that you tomorrow can make money out of this? That's a tougher question to answer. And is that a reason not to invest in it? Well, again, I would put this in my TAB category. If it floats your boat, go and do it. But don't necessarily kid yourself that you're investing because you have no idea. And it's very hard to get real transparency in what's happening. We have this illusion of transparency because we can see every movement on the blockchain. So you can see every coin that moves from address A to address B. What you don't know is who owns address A and address B and why that transfer happened. And there are big chunks of the stock held by some very big players. So supply is a really hard one to get a handle on. I'd probably stay away from some of the smaller coins, but if you want to have a punt, I'm not here to cast judgment on how people should enjoy themselves.
And again, getting back to thematic ETFs, there's different kinds of thematic ETFs which do invest in crypto, either crypto directly or crypto exchanges or various other methodologies.
So that gives you a bit of a broader thing. So rather than have to pick one coin or one technology or one application, you go, well, let's pick the 20 stocks that are most likely to benefit from this trade. That's a better way to have a more structured approach, I guess you'd call it. Obviously, by diluting your stakes, you're diluting your potential upside and your downside is fixed at your investment. So is that what you really want to do? That's the challenge in a lot of this is, why am I doing it? And am I more concerned in the moonshot, the 0.0001% moonshot where this could turn me into a squillionaire, given that my downside is capped? That's not a bad way of looking at it. But it's certainly makes for great dinner party conversations.
Vin Scully, thanks very much for joining me today.
Phil Muscatello, thanks for having me.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.